Good afternoon, everyone. Today, Sunday, 30th of May, 2021, we'll be concluding on our discussion, which we started yesterday, with respect to accounting for property, plant, and equipment in line with the requirement of IAS 16. And today, we'll be looking at the concluding part, starting from introducing the concept of depreciation. Okay, yesterday, in part one, what we discussed so far borders on the objective of IAS 16. We discussed the scope of IAS 16 and what was scoped out of IAS 16 and reason why they were scoped out. We discussed on what are the fundamental attributes of property, plant, and equipment. We went further to discuss on various definitions on key items that will come across as we more or less continue in our discussion. Okay, likewise, we started our extensive discussion on the recognition principle with respect to items of PPE and the two criteria that need to be met before an item of PPE is recognized. Okay, we went further to discuss or to explain those criteria, starting from first criterion, which borders on future economic benefits, and the second criterion, which borders on cost measurement on a reliable basis. We also went towards discussing other considerations. Okay, other considerations we discussed include small items, or what we call minor parts, as compared to major parts, the portion that constitutes inventory as opposed to the portion that constitutes item of PPE. Okay, we also extend our discussion towards asset componentization, which is discussed extensively. And under asset componentization, we identify 5 reasons why asset componentization need to be taken into consideration, and what entails item componentization, where we'll make a practical demonstration of it using aeroplane. Okay, and then in using aeroplane, we came towards conclusion that aeroplane is made of the following component parts. Okay, if I could refresh our memories, these are the component parts to which aeroplane was taken into consideration, where the major components, let me call this major components, okay? And these are the sub-components. Okay, where we have fuselage, cockpit, wings, tail, engine, propeller, and landing gear. And the subcomponents for each one of them are also more or less taken into consideration. Okay, that with respect to asset componentization. Okay, to continue on our discussion, we also discussed the issue of trying to separate hardware from software on the premise that they are more or less attached to one another, or they acquire as a single asset. Okay, that also requires us to break it on the basis that we are able to give answers to the question that will lead us towards appropriate recognition of the hardware separately from the software. And where we cannot, we are going to treat everything as an item of PPE, which will depreciate accordingly. Okay, we also discussed on initial measurement of item of PPE, where we resolved to agree that it will be measured at cost. Okay, and what constitute component of cost are more or less broken down into 3 categories. The first aspect being the purchase cost, the second aspect being the directly attributable cost, and the third aspect being initial estimates, which much more relates to provision for dismantling, provision for asset restoration, provision for more or less decommissioning costs. on such an asset in line with the requirement of IAS 37. Okay, we look at all of these in our discussion. Furthermore, we'll look at some critical discussion about self-constructed assets and also about subsequent expenditure. And we said subsequent expenditure will be treated similar to initial expenditure. And it's on the basis of asking yourself whether there's an economic benefit, future economic benefit expected from the use of such an asset. Okay, we also went further towards where we have barter trade with respect to exchanges of asset for assets, what you can also call trading, or some other people call it barter trade. Okay, and subsequent measurement also was taken into consideration, which is a measurement at every reporting date away from the initial measurement at recognition. Okay, and we said there are two models to which item of PPE can be valued subsequently. We said we still retain the cost model as the first option and the valuation model as the second option. This option is a function of the accounting policy of an entity. And the accounting policy of an entity is influenced by one, the nature of the asset, two, is influenced by the industry and practices regarding such the use of an asset within that industry, and some other factors that is pertinent, which will be taken into consideration by the board before arriving at what will be more appropriate as a basis to which asset can be measured subsequently. But we said the valuation model more or less require periodic, more or less recognition of the market value or any other similar value regarding to the asset. Okay, and this is not required to be carried out at every reporting date, but rather it is required to be carried out once there are significant movement between the market value and the kind amount of such an asset. And also is expected as such should be done not later than 3 to 5 years if such does not, if the entity does not more or less experience any material movement based on the market value as compared to the carrying amount. Okay, and another thing we also discuss is okay, that's on valuation model. We discuss on the frequency, we discuss on other features. Okay, another one we can also look at for, or what we look at for yesterday or in our part one, but that's on accounting for evaluation. Okay, where you initially recognize evaluation surplus and subsequently there's an impairment loss or decrease in evaluation, or initially recognize impairment loss or decrease in evaluation and subsequently you recognize increase in evaluation. All of these were discussed in part one. Okay, and we also demonstrated our understanding of that looking at practical illustration. I think we looked at about 3 illustrations or 2, as the case may be, yesterday. And also I think we looked at 2 practical illustrations yesterday. Okay, any other question before we further ahead? Any question, contribution before we start on what we need to discuss today? Any question? Okay, in the absence of no question, we'll start with depreciation. Now let me put it to us. What is depreciation? Over to any of us. What is your own understanding of depreciation?
Good afternoon, everybody.
Yeah, good afternoon.
Yeah, my simple understanding of depreciation is that depreciation is a gradual diminution in the value of assets as a result of wear and tear, passage of time, and economic useful life of an asset. Thank you.
Okay, who else is contributing? Okay. Now, in simple terms, depreciation is the systematic allocation of the historical cost of an asset over its useful life. Okay, that is simply put what depreciation stands for. Okay, now, what do you mean by systematic allocation? Now, systematic allocation is more or less looking at basis to which the cost of an asset can be spread and recognized as an expense and charged to profits or loss in the period it relates, so as to appropriately match with the associated income. What we are trying to say here is this: depreciation entails how we ensure that the cost of an asset is spread accordingly in a manner that ensure that the portion of the asset that is consumed is charged appropriately as an expense in order to match it with the income so generated within that period, so as to ensure that we are reporting the appropriate net income in our books. And that is why depreciation entails a systematic allocation of the historical costs. Okay, now the word historical cost I used here, okay, simply means that what you are charging is first the purchase cost, or let me use the word acquisition cost. Remember, our acquisition cost entails your purchase cost, directly attributable cost, and initial estimates, if you remember our last discussion. Therefore, the acquisition cost which has been incurred in the past have to be spread over the period to which the asset will be put to use. Okay, now the acquisition cost in this case assume that there is no residual value. which means the entire cost will be consumed over the useful life of the assets. But where the entire cost of the asset will not be consumed over the useful life of the asset, it then means that there is a portion of it that will be salvaged or that will be realized by way of a disposal after using substantial part of the life of the asset. And in that case, we say, rather than use the acquisition cost, we'll now substitute historical cost with the depreciable amount. And what is the depreciable amount? It's simply the historical cost less the residual value. Okay? Also, it could be the revalued amount less the residual value. What that signifies is that asset revalue, okay, the new value less what will be salvaged at the end of the day by way of disposal or scrap will be our depreciable amount. And this amount is what will be allocated on a systematic basis by way of an expense over the life of the assets. Okay, the last aspect of it is the useful life. What is the useful life? It's the period okay, there's a technical glitch. Okay, the useful life in this case is the period which could be in years, it could be in hours, it could be in production units, that the assets okay, there's a technical, I don't know what is wrong with the pen. Let me restart it. Now the period in years, hours, production units that the assets is expected to be put in productive use. Okay, and we're going to get there later, which means the useful life is not necessarily a month count or a year count. It could be in hours based on capacity utilization. It could be in production units or unit of output, as the case may be. Okay, that is that. Now, let's move ahead. Now, the question is it all PPE that are depreciable? Who can answer that question? Is it all PPE you can depreciate?
No.
Why?
There are some PPE does not have finite useful life.
I didn't get you, sir.
I said there are some PPE that are expected to be useful forever. That is, they are infinite in their usefulness.
Is there any asset that is infinite or asset with infinite life? The word infinite means endless, forever. Nothing lasts forever. Even the world you are in will not last forever. Therefore, I don't think that would be appropriate. Okay, any other consideration?
Yeah, for instance, now if you own a land and you're not expecting any natural disaster or maybe gully erosion to take it away from you, and probably it's not a jurisdiction where governments can acquire the land without your
Okay,
support, then it's expected that it is yours forever. And in fact, you can even bequeath it to your future generation. So.
now depreciable assets are assets that can be depreciated over time. And they are depreciable because they have predeterminable useful life, which means the useful life on the basis of reliability can be estimated, which is usually influenced by pattern of usage and past practices. Okay, whereas non-depreciable assets are assets that has indeterminable useful life or indeterminable useful life, or I won't use the word infinite, okay? And I won't use the word indefinite. And I think, let me just stop here and I will explain. Okay, indeterminable useful life means this asset probably may have useful life, but it's going to be difficult to estimate the useful life or to be able to determine the useful life, which means no asset has infinite life. No asset has indefinite life. But what they could have is what we call indeterminate useful life, which speaks to the fact that such an asset is such that you cannot, on the basis of judgment, experience, or historical data, be able to estimate the useful life. And a typical example of such is land. Okay, land is a non-depreciable asset in most jurisdictions. Okay, why is it so? Because not only that the land is freehold as an asset, but because the nature of the land is that no one can vividly, with any form of experience or otherwise, ascertain what the useful life of such a land would be. You might say the useful life is 100 years and it's far above those years. Or you might say it is 10 years and in 5 years, the land is no longer there. Erosion, environmental degradation has taken away the land in totality, which then means that in such a way, we say it's of indeterminate useful life. And that is the reason why it is non-depreciable. Okay, people argue sometimes that land is not depreciated on the premise that it increases in value. Okay, that is not correct because asset being revalued upward does not stop depreciation to be charged. Why? Because depreciation is a mere allocation of cost to the period in which those costs relate by way of recognizing as an expense. Therefore, we need to take note of that clearly. Okay, and the essence of that is that what then do we mean by depreciable assets? Now, when you say depreciable assets, we say they are assets with predetermined useful life, determinable useful life. Now, but what are the attributes of such an asset? Attributes include one. These are assets that are expected by their nature to be used during more than one accounting period. Two, these are assets that have a limited useful life. And three, they are assets held by an entity primarily for use in the production of goods and supply of services, or for rental to others, or for administrative purposes. Okay, these are the critical attributes of a depreciable asset. Okay, and that is key. Now, another key thing we need to look for is the useful life, which I've discussed also earlier. When we say useful life, we mean one of these. It could be the period over which a depreciable asset is expected to be put to use by an entity, or it could be the number of production units, or what we call output. Expected to be obtained from the assets by the entity. Okay, therefore, which is synonymous to what I've discussed earlier also about the period to which an asset is expected to be put to use can be determined in years, in machine hours or service hours, or in unit of production. Okay, that is that. Any other question? Now, I want somebody to read this out to buttress some of those points we mentioned earlier. Okay, who can read this up?
Okay. If an asset's life extends over more than one accounting period, it earns profits over more than one period. It is a non-current asset. With the exception of land, every non-current asset eventually wears out over time. Machines, cars, and other vehicles, fixtures and fittings, and even buildings do not last forever. When a business acquires a non-current asset, it will have some idea about how long its useful life will be, and it might decide what to do with it. A, keeping on using the non-current asset until it becomes completely worn out, useless, and worthless. B, sell off the non-current asset at the end of its useful life, either by selling it as a second-hand item or as scrap. Since a non-current asset has a cost and a limited useful life, and its value eventually declines, it follows that a charge should be made in profit or loss to reflect the use that is made of the asset by the business. This charge is called depreciation.
Okay, thank you. And furthermore, to buttress what we have discussed earlier, can you also identify what we mean by depreciable amount?
Okay. Depreciable amount is depreciable amount of a depreciable asset is historical cost or other amounts substituted for cost in the financial statements, less its residual value.
Okay, and that is provided it has a residual value. Furthermore,
IAS 16 requires the depreciable amount of a depreciable asset to be allocated on a systematic basis to each accounting period during the useful life of the asset. Every part of an item of property, plant, and equipment with a cost that is significant in relation to the total cost of the item must be depreciated separately. One way of defining depreciation is to describe it as a means of spreading the cost of a non-current asset over its useful life, and so matching the cost against the full period during which it earns profits for the business. Depreciation charges are an example of the application of the accrual assumption to calculate profits. There are situations where over a period an asset has increased in value. That is, its current value is greater than the carrying amount in the financial statement. You might think that in such situations, it would not be necessary to depreciate the assets. The standard states, however, that this is irrelevant and that depreciation should still be charged to each accounting period based on the depreciable amount, irrespective of a rise in value. An entity is required to begin depreciating an asset of property, plant, and equipment when it is available for use, and to continue depreciating it until it is derecognized, even if it is idle during the period.
now the emphasis here is this, okay? One, asset increasing in value does not stop us from depreciating, because the whole essence of depreciation is to allocate the cost of the asset or the surrogated cost of the asset over its useful life, so that one, based on accrual principle, we are able to more or less match expense appropriately with income to arrive at the net income for that period. Two, we identify that even when an asset is temporarily out of use, depreciation should not cease, which means we still continue to depreciate an asset that is temporarily out of use, okay? All because the depreciation is not necessarily going to stop on that basis. But the impact of that is that it could extend the life of that asset due to idleness. What does that mean? Which means item that has a capacity of 100,000 units which means it can only produce 100,000 units over its life, which means anytime the machine is not put to use, it's probably going to extend the life in terms of years, or because it has not more or less produced up to its full capacity, which then implies that that might necessitate a review of the useful life of the assets. Okay, but that doesn't stop it to be subjected to depreciation. You must take note of that. And we're going to see that with practical illustration or discussion as we move on. Okay, now I want to ask you a question. Why depreciation? Why charge depreciation? Because there are various misconceptions out there about why depreciation is charged or recognized. One of those misconceptions is that some people will tell you that depreciation is charged in order to allow you to replace an asset. Okay, but that is not correct. Depreciation does not provide you funds towards replacement. Rather, depreciation is more or less a way of allocating already incurred costs relating to an asset over its useful life. Okay, that is one misconception. Okay, another misconception is that depreciation is charged because of an asset where tears is obsolete and also of things. Not necessarily, because even an asset that does not wear, even an asset that appreciates in value, are still subjected to depreciation. Therefore, we won't conclude and say depreciation is solely attributed to wear and tear, obsolescence, or changes in technology. Rather, those can trigger more of impairment assessment rather than being considered as a basis for depreciation. Okay, those are one of those misconceptions we have, which means depreciation itself is an expense that is recognized appropriately in the period it generates an income, okay, and it is an expense that is recognized as a portion of the cost of an asset that is already incurred and of which the asset is expected to be put to use and provide economic benefit over a period of time. On that premise, can we more or less look at this expression? Okay, over to you.
Okay. Why depreciation? The need to depreciate non-current assets arises from the accrual's assumption. If money is expended in purchasing an asset, then the amount expended must at some time be charged against profits. If the asset is one which contributes to an entity's revenue over a number of accounting periods, it would be inappropriate to charge anything. It would be inappropriate to charge any single period, e.g., the period in which the asset was acquired, with the whole of the expenditure. Instead, some method must be found of spreading the cost of the asset over its useful life. This view of depreciation as a process of allocation of the cost of an asset over several accounting periods, the view adopted by IAS 16. It is worth mentioning here two common misconceptions about the purpose and effects of depreciation. One, it is sometimes thought that the carrying amount of an asset is equal to its net realizable value, and that the object of charging depreciation is to reflect the fall in value of an asset over its life. This misconception is the basis of a common but incorrect argument, which says that freehold properties need to be depreciated in times when property values are rising. It is true that historical cost statements of financial position often give a misleading impression when a property's carrying amount is much below its market value. But in such a case, it is open to a business to incorporate a revaluation into its books or even to prepare its account based on current costs. This is a separate problem from that of allocating the property's cost over successive accounting periods. 2, another misconception is that depreciation is provided so that an asset can be replaced at the end of its useful life. This is not the case. If there is no intention of replacing the asset, it could then be argued that there is no need to provide for any depreciation at all. If prices are rising, the replacement cost of the asset will exceed the amount of depreciation provided.
Thank you very much. Now, the next discussion here is what are the factors that influences how we ascertain the useful life of an asset? What are the factors that determine the useful life of an asset? Okay, from your experience, can you tell me the factor that is known to you that influences the useful life of an asset? I'll give you a clue. I can group them into 3. Can anyone name 1 or 2?
I can
Anyone?
say maybe I don't know how to put it succinctly. The period of relevance of that technology.
Okay, which means you can use the word obsolescence.
And also, if it's a kind of leased assets, then we can use the lease term to determine the useful life of the asset.
No, the lease term has nothing to do with determining the useful life of an asset. Okay?
Okay, may I say the purpose?
What do you mean by that?
I mean the purpose in which the asset is acquired for can also influence the useful life of that asset.
Okay, I think that is not clear enough.
Yeah, I think I understand what it's trying to say. Like, for instance, now maybe you purchase an asset to execute a project that will last for 5 years. So we can reasonably assume that we should depreciate the assets over the period of that project.
Okay,
Exactly.
What about if the assets still have potential? Are you not going to, if the asset can still last 10 years, because the project has ended 5 years, you write everything off? You know, that's part of the answers to the question that you asked yesterday, which you are going to put into perspective today. You know,
Exactly.
you ask that question, we are going to put it into perspective. Now,
But
another
based on your
factor,
definition of based on your definition derivatives of depreciation, is just the allocation of the costs.
yeah, we are not saying what will influence how you allocate, because useful life is the factor that influences how you allocate. And what then will you consider to determine that this motor vehicle is 5 years as against 7 years? The same motor vehicle you said 5 years, to some other person, it is 3 years. You understand? What factor influences it? Physical wear and tear, and that is always influenced by usage. The more you use an asset, the same car we bought together. If you use your own for Uber and I use my own for my personal movement, you understand? Mine would more or less have more useful life than yours, because the mileage will not be up to yours. People coming in, up and down, moving from one area to other, and all sorts of things will wear on the car, unlike mine, which that means that my car that is used personally can last as much as 8 years, while the one you use for commercial purposes might last for no more than 4 to 5 years. Does that make sense? Okay, another factor you look at is legal factor or other limits on the use of the assets. Is it an asset such that legally you lose the right to it after a certain period, which then means that every cost you have expended on the asset should be allocated by way of depreciation over the legal period you have right to it. Okay? And that might be synonymous to what you try to portray with respect to leased assets. Okay? But lease will not necessarily determine the useful life. But when we get to IFRS 16, we'll discover that you depreciate an asset over the shorter of the lease period and the useful life of the assets. Which means the useful life of the asset might be 10 years, but because what you are committed to pay for the lease, you are only expected to enjoy the benefit for 6 years. Therefore, in that case, you are going to depreciate such an asset, okay, which is the right of use of assets. You depreciate it only over 6 years rather than over 10 years in which the asset will last. Why? Because after 6 years, you lose your legal right towards having control over the assets. Does that make sense? Okay, now these are the 3 factors that we consider in determining the useful life of the assets. Okay, now let's look at this. I want Madam Uwankwo to read this for us in respect to what we have discussed.
Okay. Once decided, the useful life should be reviewed at least every financial year end, and depreciation rates adjusted for. And depreciation rates adjusted for the current and future periods if expectation varies significantly from the original estimates. The effect of the change should be disclosed in the accounting period in which the change takes place. The assessment of useful life requires judgment based on previous experience with similar assets or classes of assets. When a completely new type of asset is acquired, that is through technological advancement or through use in producing a brand new product or service, it is still necessary to estimate useful life, even though the exercise will be much more difficult. The standard also points out the physical life of the asset might be longer than its useful life to the entity in question. One of the main factors to be taken into consideration is the physical wear and tear the asset is likely to endure. This will depend on various circumstances, including the number of shifts for which the asset will be used, the entity's repair and maintenance, including a maintenance program, and so on. Other factors to be considered include obsolescence due to technological advances or improvements in production or reduction in demand for the product or service produced by the asset, and legal restrictions, e.g. length of a related lease.
Thank you, ma'am. Thank you. Now, let's now go back to the question Shegun asked. Shegun, can you ask your question again? The question we have deferred to today. Put it in the right perspective and let us now look at whether such situations should have occurred in the first instance and what then should we do? Can you go ahead with your question?
Okay, my question is that I have come across situations whereby a company not fully depreciated an assets, and that means that the net book value had become zero, and the assets is still being put to use by the organization, especially motor vehicle, and they still use the motor vehicle to go around for the purpose of the business. So I'm not saying that is this correct and what should be done in this situation when the asset is still existing and being put to use.
Okay, now the first thing we need to ask ourselves is this. If initially you have estimated the useful life of your car to be 4 years, as you use the car year in, year out, the condition of the car should be assessed by you, whether such car can have an extended life. And if such is now ascertained, what then do you do? The position of the standard is that at least once every year, you must review or revisit what the useful life is. The essence of it is that if the car can still last additional 2 years after the end of the 3rd year, you will extend the useful life by additional 2 years and therefore depreciate the remaining carried amount over the 3-year period. How do you make up 3 years? You know, the car was initially 4 years, 3 years has gone, and you observe that you can see it for 2 additional years after the last year, which means the last year is year 4, 2 additional periods make it 3 years to go. The remaining carrying amount will now be depreciated over the 3-year remaining period. Does that make sense? Which means on no basis, if you have done what the standard requires you to do every year, in each of the year, you will have ascertained whether the asset might have extended life or might have accelerated life. Extended life means that the asset can be used beyond your initial estimated useful life, which means you have to now revise and increase the useful life remaining. Or can be accelerated, which means initially you said it will be 4 years, but the condition of the car has shown that it can last for more than 3 years, which then means that you now accelerate depreciation. Okay? Why, if it's going to extend, you defer more of the depreciation to future what? Periods. And that's what it means. Now, that also forms the basis of us asking ourselves a question. Does that now mean that this should influence our accounting policy as an entity, either to adopt costs for such class of asset or to adopt revaluation model? Now, if you have adopted a revaluation model, such will have triggered the need to revalue the asset upward in order to depreciate it for more extended periods than what it is. Which means if you go by all what I've explained, it should be practically impossible for you to find yourself in such a situation. Because if the needful have been done periodically, you will have done the needful by way of recognizing the appropriate portion of depreciation, which means what you have simply done is that you have more or less recognized more depreciation than what you're supposed to have recognized in the earlier periods. Does that answer the question?
Yes, sir.
Okay.
I have a question.
Yes, ma'am.
Yeah, most of our clients are SME, and most of them, at the end of the policy, the accounting policy, with the year of the useful life of the assets, we find out that they are still using the assets, even though the maintenance cost has gone high, and we have advised them that this thing is weighing on the financial position of the organization, that maybe they need to replace the asset. It has already gone through the useful life, but they are still maintaining and keep going on. In that regard, revaluing I don't know, I just seek your opinion that revaluing the assets, because going to market to find maybe market value or fair value might be even very, very, in the market, the market price might be really very, very small, for you to start. Even the cost of evaluation might even be more than the cost of the asset. So what do you advise the kind of treatment one can give to such an asset?
Okay, thank you very much. Thank you very much. Now, first thing is that you are not going to decide to say, I want to revalue an asset because I still have the asset in use after the initial useful life. It's a policy issue, which means, is it your accounting policy? If your accounting policy is not to revalue, it will not be after 5 years when the asset has been fully considered to have exhausted its useful life, but the physical life is still extended, you now want to revalue. No, because that asset does not fall within the class of revaluation model. Okay, what answers your question is based on the first scenario or first leeway I provided to Shego. And that leeway is that if your asset will have a prolonged life, at every reporting date you revisit the useful life, and that will influence you to spread the depreciation more over an extended period. And if you have done that, you will not have found yourself in a situation where the asset, after exhausting its useful life, you still have it put to use. Now, there's now an economic or financing decision to say, a company should look at it, and that's not an accounting decision, but it's a finance decision to say that this asset, even though physically is there, but economically it has outlived its useful life. Therefore, what can I do? Is for me to rather jettison the asset by way of disposing it of or abandoning it, since my maintenance cost is now much more higher, which will not make economic sense to still say I want to continue to use the asset at the detriment of the impact on your financial performance due to unnecessary or avoidable high cost of maintenance and repairs. And that is a call for an organization. You know, that's why sometimes in finance, we tell people that you don't need to be penny wise and pound foolish. You understand? Because the question is, if you have bought a new car, the maintenance cost will have been more or less negligible. But when you continue to use that old car, after it has used up its economic life, which is different from your physical life, therefore, at the end of the day, cost incurred in trying to put the asset to use will be onerous on the company, so that the benefits associated to it will be far below the cost incurred. And that will be a finance decision of the organization in order to do the needful. Does that make sense, ma'am?
Yeah, it does. But in case, I'm talking from the point of an auditor, not from the point of an accountant. Like, you advise, we do, there are times, because most of them are SME, we do advise the clients, oh, this thing, like I've explained, but still, they still maintain the status. So, and we do put it in our management letter, and we have even fully depreciated the asset. So what do we do in that regard?
What you do in that is that such an asset will be presumed not to be in existence, which means it's not put to economic use. It's just there.
Okay.
You understand? They might continue to use it the way they like, but at the end of the day, it's going to more or less take a toll on the financial performance of the company, being the fact that they continue to incur humongous maintenance and repair costs. You as auditor, yours is to more or less express opinion, advice, and all sorts of things. You understand? But management might continue to run the organization in a manner that the profitability of the company is going to dwindle down. Does that make sense, ma'am?
Yeah, it does. But this is what we do most of the time in practice. Like such assets, we just leave one error in the account to indicate that that vehicle is still, because in future they might just wake up what they are dispose the asset. So we do leave one error in the account. What do you say about that, sir?
What is the base of leaving one error in the account? Some people will leave 10 error.
Okay, excuse me, sir. This is exactly the question I was waiting to ask you.
To indicate that the asset still exists.
Yeah, even so that when we are always leaving a sum of 100 naira as the net book value.
Some people leave 10 naira. I want to know
the rationale for
some leave.
There's no rationale for it. What has happened is that we have infused our knowledge in the days of SAS, which is Nigerian GAAP to IFRS. Some people will put 10 naira, and they got 10 naira from the angle of tax law. And that 10 naira is not relevant even in tax law again. What is 10 naira? Does it even change anything? Okay, SME pick 1 naira. So you said you pick 100 naira. Therefore, all of those naira you are picking have no basis. That's why we are going to discuss what is residual value. What should be left should be the residual value. And what then is the residual value? Do you get what I'm saying now? Okay. And take note, we've told you what matter in an asset is the economic life of an asset, not the physical life. That is why if you come back here, the standard also point out that the physical life of an asset might be longer than the what? Useful life. The word useful life is economic life. That is, economic life is what a rational management or investor consider as what is fruitful for putting this asset to use. Do you understand? If you have a sound management, it will make sense using an asset or for the purpose that the asset still exists, when at the end of the day, you are incurring costs that outweigh the benefit of usage of such an asset, which means you are focusing much more on physical life rather than what? Economic life, which is the basis to which you depreciate an asset. Okay, that is that. Now let's look at residual value. Okay, alternative to residual value is what we call the scrap value or disposable value after the economic life of an asset. Now let's look at this. What does this speak to us?
Okay, residual value. In most cases, the residual value of an asset is likely to be immaterial. If it is likely to be of any significant value, the value must be estimated at the date of purchase or any subsequent revaluation. The amount of residual value should be estimated based on the current situation with other similar assets used in the same way, which are now at the end of their useful lives. Any expected cost of disposal should be offset against the gross residual value.
Thank you. Okay. Now let's shift forward a little. What are the methods to which you can use to spread the cost of an asset over the useful life? Such method is what we call the depreciation method. The question then is, what are the available method of depreciation and which one is acceptable? Okay, now the standard does not necessarily determine which depreciation method is appropriate. Okay, it is left to the judgment of the management to determine what depreciation method reflects the pattern of consumption of an asset, reflects the way and manner an asset is put to use. But one thing that is clear there is that, one, depreciation method that you have adopted must be used consistently, which means the first factor to consider is that, one, depreciation method should reflect the pattern of consumption or usage of an asset. That's one. Two, the depreciation method adopted should be used consistently. That is, consistency is the key word. Three, depreciation method. Can only be changed if the change is to reflect the new pattern of consumption or change in usage, which means depreciation method should not be changed solely to effect desired profitability or financial performance, which means you are not changing the depreciation method in order to accelerate the charge so that it reduces your profit for whichever purpose you intended to do, or you defy it in order not to reduce your profit. No. The only basis to which you change the method of depreciation is only when it reflects the new pattern of consumption, which more or less ensure that we ensure that our financial performance is a reflection of the true activity and performance of the entity. And in that regard, a change in the depreciation method should be treated as a change in accounting estimates and not a change in accounting policy. Which means change in depreciation is a change in accounting estimates and not a change in accounting policy. And what is the implication of that? If it is considered a change in accounting estimate, it means the effect of the change in depreciation will prospectively affect the profit or loss of the company. But if it's a change in accounting policy, it will retrospectively affect, which means you'll go back as far as practicable from the initial point to which the asset is brought into books, and you readjust from the inception, which is not the case, because a method of depreciation is a method that reflects pattern of usage. And once your pattern of usage changes, you can change your depreciation method, and that will be treated as a change in an accounting estimate. And that is in accordance with the requirements of IAS 8. Okay, have you watched the video I shared with you on IAS 8? How you formulate accounting policy within an organization, and how you effect a change in accounting policy and its accounting implication, and where there's a change in accounting estimate vis-a-vis when you are to correct for an accounting error. If you have not, kindly go on to watch that. Okay, that is that. Now, on this premise, I'll use this to summarize what I've discussed earlier. Okay, can you read this?
Okay, consistency is important. The depreciation method should be applied consistently from period to period unless altered circumstances justify a change. When the method is changed, the effect should be quantified and disclosed, and the reason for the change should be stated. Various methods of allocating depreciation to accounting periods are available, but whichever chosen must be applied consistently to ensure comparability from period to period. Change of policy is not allowed simply because of the profitability situation of the entity. You should be familiar with the various accepted methods of allocating depreciation and the relevant calculations and accounting treatments which are revised in questions at the end of this section.
Now let's give examples of acceptable methods. Okay, can anyone give me example?
We have the straight line method.
No, I won't take that from you. That is my own straight line method. Okay, which other method known to you?
Reducing balance method.
Reducing balance method.
A revaluation method.
What do you mean by evaluation method?
Just a revaluing of assets.
No, that's not a methodology of depreciating.
Okay.
You have also contradicted yourself because you are talking of revaluation of an asset, okay?
Sum of the year digits method.
Sum of the year digit method. Okay, what other method? What other method? Auditors, what other methods have you come across in practice?
Honestly, I've only come across straight line method. That is what every organization uses. So.
Okay, some should have come across units of production.
Unit of
No.
That is output of production or production output. Okay, some should have come across machine hours, machine or service hours, etc. Okay, you can use as many as possible. If you are in oil and gas industry for upstream, the method for DD&A, which means depreciation, depletion, and amortization, is usually based on output. That is based on your proved reserve. What quantity have you lifted out of the ground? You use that percentage to determine your depreciation, which is equivalent of unit of production. Okay, now who can give us clue about differences in each of the methods and which method is more appropriate? Over to you. Who will guide us? Nobody?
I think I can talk about 1 and 2.
Okay, say something about 1 and 2.
Okay, straight line method is when you try to charge an equal amount of depreciation over the economic useful life of the asset.
Why are you trying to charge an equal amount of depreciation over the economic life of an asset? Why? Why are you doing so?
Yeah, it's based on the assumption that it's based on the assumption that you expend the same thing over the year, over the useful life of the asset. That is just what I can say.
Okay, the assumption there is that the asset based on pattern of usage will be used equally, in which case, for example, building. Okay, they expect that the building, the benefit you derive from it will be the same because it gives you that occupancy equally over 40 years, over 50 years, or what the useful life may be. In that case, you spread the cost. But when you deal with old age cars, what would be the appropriate method to use for old age cars?
Yeah, I can say reducing balance method, and it's based on the assumption that it's much more effective when you newly acquire them than in the later time, later
Okay.
in the life of the assets.
Okay, what about
You
if
tend
I
to
decide to
start
use
before.
mileage? I say, what if I want to use mileage? Won't it be more appropriate?
Yeah, it will be more appropriate.
It's also reflecting reducing balance method, but it's more scientific, more than reducing balance method in that regard. If it's aeroplane, I can use flight hours for certain component parts of aeroplane, especially for engine, landing gear, and some other things. You are going to see that. Now, again, these methods are methods that will likely reflect the pattern of usage. Now, let's look at this question. This question says that a lorry bought for business costs $17,000. It's expected to last for 5 years and then be sold as scrap for $2,000. Usage of the car is for 5 years. Okay, the expected usage is as follows. In year 1, you use it 200 times. Year 2, you use it 100 times. Year 3, 100 times. Year 4, 150 times. And year 5, 40 times. The question then is, first, what is the depreciable amount here? Who can tell me what the depreciable amount is? What is the depreciable amount here? The depreciable amount is the cost minus the scrap or residual value, which means the portion you depreciate over the 5-year period is the $17,000 less what you realize after the useful life of the asset, which means you have to depreciate what? 15 over 5 years. And doing this, you can adopt any of these methods, provided you have available information. Okay, in that case, let me give us this requirement now. Now I'll give you, okay, I think time is not on our side, but let's look at it one by one. Straight line method, what it means is that this 15,000 equally over what? 5 years. How much is that per year? Can you press your calculator?
$1,000.
That means in that regard, it's $3,000. Does that make sense? Which means the depreciable amount is 15, which will be spread over what? 5 years. Okay, what if is reducing balance method? Reducing balance method, what method does it adopt? It means it depreciates on the cost and using certain percentages so that at the end of the day, there will be certain balance left in the books as at the end of the useful life. And who can explain the calculation we've done here? Who can explain it for us?
Okay, let me go ahead. Using reducing balance method. In the first year, we can say that the cost of the asset is $11,000. And based on reducing balance method, we are expected to use 35% as depreciation. Okay, in the first year, we charge 35% of $17,000. Our depreciation in the first year is $5,950. In the second year, what we need to do is to remove the depreciation in the first year from the total costs, which will give us the net book value of that asset. Then in the second year, we charge 35% of the net book value, which is equal to 11,050 $50. 35% of 11,050 equals to $3,868. That is our depreciation in the second year. Then in the third year, we carry out the same method, looking at our net book value in the second year, which was 11,050, minus depreciation for the second year, which was 3,868. Then in the third year, we charge 35% of the balance, which is $7,182. Then the depreciation for the third year equals to $2,514. We use the same method in the fourth year by removing the depreciation for the third year from the net book value in the third year, which is $7,182 minus $2,514. Then we charge 5% of the 168. Then our depreciation 1,634. Okay, we carry out the same method by removing the depreciation in the fourth year from the net book value in the fourth year. And okay, we charge in the fourth year, we charge 35% of 4,668, which the result was 1,634. Okay, in the fifth year, what we do is to look at our in the fifth year, we removed depreciation in the fourth year from the net book value in the fourth year, and our result was $2,000. And that $2,000 is the scrap value in the fifth year. Thank you.
Okay. Thank you very much. Now, let me share this with us. Now, let us use this to further buttress what we've done. Now, in the first year, the basis will be 35% on the initial cost. Okay, what is the initial cost? $17,000. Okay. Now, 35% of this Okay. Now, 35% of initial cost is 5,950. At the end of the day, what will be the net book value will be the difference between the initial cost and the depreciation charge for that period. Okay, now in the second year, it will be 35% of the net book value. At end of year one. Which means it's still this product, but the net book value now is this amount. And that's how we got this amount. At the end of the day, what is the net book value now? It will be the net book value as at end of year one minus depreciation charge of year two. At the end of the day, in year three, it will be net book value of year two. And that will be this. And the net book value in year three will be the net book value in year two minus the depreciation charge of year three. Now, in year four, it will be 35% of net book value of year three. And that gives me this. And the net book value at the end of year four is 3,034. Now remember that the useful life is 5 years in all. Let me put it here. Useful life is 5. Therefore, and my depreciable amount is the difference between the cost and the scrap value, which means what I can depreciate should not be more than $15,000 all in all over 5 years. The question then is, how much have I charged so far? I've charged $13,965, which then means that in the last year, there are two ways to doing it. I can just say the difference between the depreciable amount and the sum of depreciation in year 1 to year 4. Which means I'll say the 15,000 minus the sum of depreciation so far. And that gives me this amount. So that at the end of the day, my net book value will be what? 2,000. Which is this 2,000 here. Does that make sense? And that is that. Any question on reducing balance method? Okay, let's come back to our discussion. Now, let's look at some of the year digits. Who can interpret the solution under some of the digits? Sorry, this is machine hour, sorry. Who can interpret the solution under the machine hours? The total usage over 5 years is 590 days, which then means that the depreciation rate per day, since you use days to measure it, is your depreciable amount of 15,000, which is the difference between 17 and 2,000 divided by 590 days, which means each day costs $25.42. And you now apply it on all of these days to arrive at your depreciable amount. Subject to rounding error, this will have been 15,000. If you use Excel, you get it to the last digits. Okay? Now, the answer does not come to exactly 15 because of the rounding error. But if you use spreadsheets, everything will come to the nearest cent. Okay, that is that. Now let's look at the final one, the sum of the year digits. It's synonymous to reducing balance, but rather it uses year counts. Okay, who can interpret sum of the year digit method? Who will interpret that? Bashir.
For the sum of the year digits method, it looks into the number of years that the asset will be put into use. And we have from first year to fifth year. We now use those years, we place it as digits, meaning 1, 2, 3, 4, 5. Then we take summation of all the numbers that the assets will be put into use, which is equal to 15. However, we now depreciate based on the digits, and we started with year 5. That in year 1, sorry, we started with year 1, but in year 1 we assume that the consumption for year 1 will be higher. It will be much compared to the rest of the year. That is why we started from the highest figure, which is 5, divided by the denominator, which is the sum of the year digits, and that is 15. And when we charge depreciation for year 1, we have 5 divided by 15 multiplied by 15,000, which is the depreciable amount, and the result is $5,000. Then we move to year 2. The digit for year 2 is 4, divided by this total sum of the year digits, which is 15, and multiplied by 15,000, which is the depreciable amount, and the result equals to $4,000. And in the third year, we pick the third digit, which is 3, divided by the total sum of the year digits, which is 15, multiplied by the depreciable amount, and the result is $3,000. We did for year 4 the same method, and likewise year 5. And if we sum up all the results for our depreciation, it will equivalent to $15,000. Thank you.
Okay, thank you. You got it right. That is good and perfect. Now, let me put this question to you guys. Who will come forward to answer this question before I project one thing that could wrap it up in that manner? What are the purposes of providing for depreciation? And in what circumstances is reducing balance method more appropriate than straight line method? Give reasons for your answer. Madam Grace, can you assist us here, ma'am? Madam Grace,
Yes,
can
sir.
you assist us? Kindly assist us here.
Okay. Question 1 states, what are the purposes of providing for depreciation? And like the definition is due to the properties, depreciable properties, depreciable PPE, due to wear and tears and obsolescence, no matter what, depending on the situation that is applicable, to write off the cost of the assets over the economic useful life of the useful life of the assets. That's one purpose. Then secondly,
Yeah, in one circumstances is the reducing balance method better off in use than straight line method.
okay, reducing balance is better than straight line method, and the fact that the year, it is assumed that the assets will be at utmost use in the first year, and will be more efficient at the earlier year of the asset than the later years. So that is one of the reasons why, and it's better to make provision for it at the earliest year than the later years when the performance of the performance of the asset might have reduced.
Okay. Now let's look at this. Madam, can you read it out as a justification for the answer you've given? What are the purposes of providing for depreciation? Can you read this out? Hello, can you hear you? You are muted.
Sorry. A, the financial statement of a business tries to recognize that the cost of a non-current asset is gradually consumed as the asset wears out. This is done by gradually writing off the asset cost to profit or loss over several accounting periods. This process is known as depreciation and is an example of the accrual assumption in IAS 60, property, plant, and equipment, requires that depreciation should be allocated on a systematic basis to each accounting period during the useful life of the asset. With regard to the accrual principle, it is clear that the profits should be reduced by the depreciation charge. This is not an arbitrary exercise. Depreciation is not, as is sometimes supposed, an attempt to set aside funds to purchase new non-current assets when required. Depreciation is not generally provided on freehold land because it does not wear out unless it is held for minimum etc. That's all, sir. That's all I can say.
Okay, now the second question is, in what circumstances is the reducing balance method more appropriate than the straight line method? Can you read it up?
All right, sir. The reducing balance method of depreciation is used instead of the straight line method when it is considered fair to allocate a greater proportion of the total depreciation amount to the earlier years and a lower proportion to the later years, on the assumption that the benefits obtained by the business from using the asset decline over time. In favor of this method, it may be argued that it links the depreciation charge to the cost of maintaining and running the asset. In the In the early years, these costs are low and the depreciation charge is high, while in later years, this is reversed.
Okay, thank you very much. Now, I want to show you something here. Let me share this. Now, I wanted to provide you practical question on aeroplane. Now, let me just give arbitrary cost. Now, this is the total cost of an aircraft in Nigerian naira. Okay, and the useful life is based on these parameters. Yeah. For the fuselage, is based on the number of years. And let us say an average aircraft will have 20 years with respect to the body, which is the main container. Okay, and these other instruments can vary from 8 to 12 to 6 to 10 to 15 to 5. Flying hours, they might tell you 12,000 hours, 5,000 hours. All these are hypothetical. 8,000 hours, slab, 5,000 hours. Engine can go as much as say 10,000 hours. Propeller, back tire, number of landing, 500 landing, Front can be 350 landing because of the impact. Stroke can be 300 landing. Okay, these are the parameters given to us. Okay, now let me now create for the year what was used. Usage in the year. Let me say that's our first year. Now, first year, we have only used 1 year in all of this. These are those ones in years, they are just in the first year. These are our first year. Now, hours, yeah, probably we have used number of hours. Let's say we have used 600 hours. Number of landing, let's say we have landed 120 times. Now the question then is, what is our depreciation? What's our depreciation charge? And what's our carrying amount per component? Okay. Okay. Now, what then do we do as our depreciation? Now, our depreciation, this is 1 year out of 20 years has been consumed of the cost. And that is that for each component part that is based on number of years. Now, flying hours that have been consumed is also a factor to determine what portion has been incurred as depreciation expense. Okay, and number of landing. Out of the total landing expected of this. And at the end of the day, the first year depreciation charge sum up to 39.7 million out of 534 million, which means our carrying amount will be the difference between the cost of each component and the depreciation charge. And at the end of the day, our carrying amount is 494.5 million naira. Now, this is the whole process of componentization of an asset. Does that make sense to you? Any question? Any question?
I have a question, sir.
Yeah, what's your question?
Okay. The other time when we were discussing about the earlier part of the depreciation, you made mention of not stopping the depreciation to depreciate an asset, even though even when the asset is not
As
in
the asset is
use.
temporarily idle.
So my question is, at what point do we start depreciating an asset? Is it when the cost is
No, I think your network is bad. Your network is bad. Can you repeat your question from the beginning? Your network is breaking.
My question. Oh.
Can you repeat?
Okay. My question is, at what point do we recognize, do we start depreciating an asset? Is it at when the cost is recognized or when the asset is being put to use?
Okay, I think we'll also discuss it. Depreciation starts from the day the asset is available for its intended use. Whether you now use it or not is secondary. Once an asset is available for its intended use, depreciation commences immediately. For example, will you depreciate a backup generator? Hospital have 2 generators running, and they have the 3rd generator as backup. But that backup is only in case of emergency that 1 or 2 of those generators are not functioning. Therefore, they can easily trigger the 3rd one. But the 3rd one has not been used in the last 1 year. Will you depreciate such a generator?
I think my answer will be yes, if the cost has been recognized in the books.
The answer is yes on what premise?
That if the cost of the asset has been recognized in the books.
But cost may be recognized, but the asset is not yet available for its intended use, especially for self-constructed assets.
Okay, I won't depreciate. There won't be any depreciation because it has not been used.
No, that's not correct. There will still be depreciation because the whole essence of having that 3rd generator is to provide you comfort for backup. And is it providing that comfort for backup or not? It is, even when you have not put it to use. Which means the requirement of the standard is not as when you have aggregated the cost, but rather when the asset in contention is available for its intended use. Once it is available for its intended use, regardless of you have put it to use, such an asset will still be subjected to depreciation. And likewise, if an asset has been put to use before now, and it is idle temporarily, and it has not yet been abandoned, such an asset will still continue to be depreciated during the period of idleness. Does that make sense to you?
Yes, it does. I have another question.
Okay.
Can I go ahead?
Go ahead, ma'am.
Okay. The other part is that theory that land is not a depreciable asset, and we made mention of saying that depreciation is not because an asset is I'm familiar. Okay, that appreciating when an asset appreciates does not stop the asset from depreciation. So my question is, if in some jurisdiction a land is not a depreciable asset, then what happens in other jurisdictions where what's it called? Some factors of that land being a depreciable asset cannot be ruled out. Take for instance, let's say a farming land now here in Nigeria, in some areas where you have a constant erosion, So, that factor cannot be ruled out that land maybe in another 1 or 2 years will not be available for its intended purpose. So my question is, why should that land not be a depreciable asset based on its jurisdiction? Rather. That's my question.
Okay. Now you must also take note that though you didn't depreciate land, does not mean land, like any other asset, will not be subjected to impairment test. Now, erosion is an indicator that the land has been impaired. And what we do in that instance is to impair that land, okay, and recognize it as an expense, but not as a depreciation. Does that answer your question?
Yes, very well. Thank you.
Okay. But again, I'll put it to you that not all jurisdictions will have their land not depreciated. For example, I think in Hong Kong, the nature of the land is that no one owns land, but you lease it outrightly from government. And once the lease period expires, the land reverts directly to government. And in that situation, you have to depreciate such a land. Because remember, depreciation deals with also the legal title you have over that asset, such that the useful life of an asset is influenced by the legal rights over that asset. And in that instance, such an asset, regardless of the nature, will be subjected to depreciation over the limited useful life in that regard. Which means not necessarily in all countries will you find land to be a non-depreciable asset. It could also be a depreciable asset, but it's in a rare situation. For example, when you lease land, okay, under IFRS 16, such a land that is under lease will equally be depreciated by way of right of use of that asset. And we'll discuss that when we get to IFRS 16. Does that make sense now?
It does.
Okay.
Thank you.
Yeah, let's forge ahead in our discussion. Now, I want you to be familiar once again with the following terminologies with respect to depreciation as a charge. Okay? Who can read this for us?
Let me read. The standard states. Okay. Can I go on?
Yeah.
Okay. The standard states 1. The depreciable amount of an item of property, plant, and equipment should be allocated on a systematic basis over its useful life. 2. The depreciation method used should reflect the pattern in which the asset's economic benefits are consumed by the entity. 3. The depreciation charge for each period should be recognized as an expense unless it is included in the carrying amount of another asset. Reference by IAS 16 paragraph 48. Land and buildings. Land and buildings are dealt with separately even when they are acquired together, because land normally has an unlimited life and is therefore not depreciated. In contrast, buildings do have a limited life and must be depreciated. Any increase in the value of land on which a building is standing will have no impact on the determination of the building's useful life. Reference to IAS 16 paragraph 58.
Okay, now let me expatiate on land and building. Land and building is what we otherwise know as property. Okay, you know, sometimes you might buy land and you build yourself. And most times you buy the property in which land is a component of. Okay, when you buy land and you build yourself, it's very straightforward because you know the cost of the land and you know the cost of the building. But when you buy a property that is constructed not by you, therefore you are buying two components in one. The question then is, you must find a logical and systematic way of ensuring that you split the property into depreciable components, which is building, and into non-depreciable component, which is land. And one of the ways you can do that is that you ask yourself, what is the rateable value or what is the market value of land in that particular area? And what is the estimated cost of building that kind of structure? If you know those values, you now use them as a basis of apportioning that property cost into land components and into building what? Components. The land component, because it has unlimited life, will not be depreciated. The building component, because it has limited life, will be depreciated. Does that make sense?
It does.
Okay. Any other question?
Yeah, please, can you explain this further? The third point here, the depreciation charge for each period should be recognized as an expense unless it is included in the carrying amount of another asset.
I didn't get you.
Okay, I was asking if you can explain further the third point, that the depreciation should be expensed unless it is included in the carrying amount of another asset.
Okay, what it means is that depreciation is an expense that have to be charged to profit or loss. Okay, but in some instance, depreciation is aggregated, okay, as part of carrying amount of an asset. Okay, for example, if you self-construct an asset and you make use of plants in constructing that asset or equipment, the depreciation charge on that asset will be part of the incidental cost to the construction of that asset, which rather than being expense, it will be capitalized along with the cost of that asset. And that's what it is. Okay. Now let's look at the frequency of review of useful life of an asset. We've discussed it before, but I still want to reiterate it for a reason. Okay. Now, how frequent do you review the useful life of an asset? It's very straightforward. You do it at least every year. Okay. Can somebody read this for us?
Frequent review of useful life of an asset. A review of the useful life of property, plant, and equipment should be carried out at least at each financial year end, and the depreciation charge for the current and future periods should be adjusted if expectations have changed significantly from previous estimates. Changes are changes in accounting estimates and are accounted for prospectively as adjustments to future depreciation.
Okay. Now I'll give you a question that will explain further where we have changes in that we have to review the useful life of an asset. Okay. Can somebody read this and let's approach it?
Okay.
Sorry, I'm coming.
Yes.
Okay, can you read this?
Illustration. BCO acquired a non-current asset on January 1, 20x2 for $80,000. It had no residual value and a useful life of 10 years. On January 1, 20x5, the remaining useful life was reviewed and revised to 4 years. What will be the depreciation charge for 20x5?
Okay, remember January 20x2, which might be January 2012, up to December 2014 will have been 3 years. And that depreciation will have been 80,000 divided by 10, which is 8,000, that's 800 per year. No, sorry, 8,000 per year. And 3 years has gone. That 3 years will be $24,000. Okay, which means after 3 years has passed, you have 7 years left. Okay, but on 1st of January, the remaining life was revisited and revised to 4 years, which means the life of the asset has been cut short from 7 years to 4 years, which means the balance, which is the difference between 80,000 and 24,000, which is the net book value of 56,000 of the asset, will now be depreciated only over 4 years rather than 7 years. And on that premise, what do you have? You have this information, which means going forward, your depreciation for the next 4 years will be 14,000 as against 8,000 for each year. And that is what the impact of carrying out a review of the underlying factor is. One, you review the residual value, you review the useful life, and you also review the pattern of consumption or usage that might warrant you to change the method of allocating on a systematic basis the historical cost of an asset. Any question? Any question? Okay, can you read this for me?
Okay. The depreciation method should also be reviewed at least at each financial year end. And if there has been a significant change in the expected pattern of economic benefits from those assets, the method should be changed to suit this changed pattern. When such a change in depreciation method takes place, the change should be accounted for as a change in accounting estimate, and the depreciation charge for the current and future periods should be adjusted.
Okay, that is the implication of prospective adjustment of changes in
Accounting estimates.
Thank you. Okay, now let's look at situation where we have impairment of the asset values. How do we treat them? Which also corroborated what we have discussed yesterday and which we are repeating now. Over to you.
Impairment of asset values. An impairment loss should be treated in the same way as a revaluation decrease. That is, the decrease should be recognized as an expense. However, a revaluation decrease or impairment loss should be charged directly against any related revaluation surplus to the extent that the decrease does not exceed the amount held in the revaluation surplus in respect of that same asset. A reversal of an impairment loss should be treated in the same way as a revaluation increase. That is, a revaluation increase should be recognized as income to the extent that it reverses a revaluation decrease or an impairment loss of the same asset previously recognized as an expense.
Okay, now, I made mention of major overhaul. which is different from repairs, okay, yesterday or in our part one. Now, how do you treat overall? Overall is treated as subsequent expenditure to the initial cost of an asset, and it has to be taken as a component of its own, which means when you have a major overall, it's going to be treated as a separate component in the sole purpose of ensuring that the cost of such an overall is depreciated over the life of that overall. What does that mean? Overall has its own frequency. If it's a plant, let's say a turbine plant, the overall might be required every 5 years, which then means that the cost of that overall that is done today will have to be componentized in such a manner that it will be depreciated over 5 years until the next overall is due. And that is a position which the standard has provided as does. Where an asset requires regular overall in order to continue to operate, the cost of the overall is treated as an additional component, and such should be depreciated over the period to the next overall. Okay, that is that. Any other question before we proceed? Any other question? Okay. Next aspect is retirement and disposal of an asset. Asset retirement means an asset that outlives its economic useful life, even though it's physically present. Such an asset will be considered abandoned and should be recognized because it's no longer put to use. And when it is disposed of by scrapping it by way of getting certain amount out of it, therefore it is deemed to have been disposed. And such disposal will be accounted for in order to ascertain whether there's a profit or loss on such disposal to be recognized in the period that sales was carried out. Can somebody read this up for me?
Okay, asset retirement and disposal. When an asset is permanently withdrawn from use or sold or scrapped, and no future economic benefits are expected from its use or disposal, it should be withdrawn from the statement of financial position, IAS 16, paragraph 67. Gains or losses are the difference between the net disposal proceeds and the carrying amount of the assets. They should be recognized as income or expense in profit. Disposal of
okay. Disposal, when you dispose a revalued asset, okay, what do you do with respect to disposal of a revalued what? Assets, okay? How do you treat the initially recognized revaluation surplus in your books? What alternative exists also? Can you read this up?
Disposal of a revalued asset. When a revalued asset is disposed of, the entity can choose whether to leave the amount in the revaluation surplus in equity or to transfer it directly to retained earnings. Any revaluation surplus may be transferred directly to retained earnings. Alternatively, it may be left in equity under the heading revaluation surplus. The transfer to retained earnings should not be made through profit or loss for the year. In other words, it must not be made as a reclassification adjustment.
Okay, what that simply tells us is that when you dispose an asset off and it has revaluation surplus before now, such surplus can be reclassified directly to retained earnings from revaluation reserve. Alternatively, you might leave it there under the heading revaluation reserve. But I always encourage that you reclassify it so that you don't mix it up with valuation reserve that belongs to existing assets. Okay, and that is that. Okay, now the recognition. Can you read this up for me?
Okay. The recognition.
Sorry, that's not it.
Please, can I ask a question, sir?
Yes.
Because you said something now when you said we are advised to always reclassify to retained earnings, any revaluation surplus on the disposed assets. But there's this
when the asset has been disposed of.
Yeah, when the asset has been disposed of. But the last paragraph here says this transferred to retained earnings should not be made through profit or loss for the year. In other words, it must not be made as a reclassification adjustment.
No, no, no. What they are saying is that it must not be recycled through profit or loss before it gets to retained earnings. It goes directly from the valuation reserve to retained earnings, and you do that within the statement of changes in equity. That's why when you go back to IAS 1, okay, items of other comprehensive income are grouped into two. Those items that will be recycled to profit or loss, and those items that may not be recycled to profit or loss. And one of those items that may not be recycled to profit or loss includes revaluation reserve upon disposal of an asset. Does that make sense?
Okay, sir.
That's what it means, yeah. Okay, can you read on this derecognition? Okay,
derecognition. An entity is required to derecognize the carrying amount of any item of property, plant, and equipment that it disposed of on the date the criteria for the sale in IFRS 15, revenue for contracts with customers, will be met. This also applies to parts of an asset. An entity cannot classify as revenue a gain which it realizes on the disposal of an item of property, plant, and equipment.
Okay, thank you. Now, I want to put this question before you, and if you can read it up and let me give you a short answer to it. Okay, can you read it up?
In a statement of financial position prepared in accordance with IAS 16, what does the carrying amount represent? B, in a set of financial statements prepared in accordance with IAS 16, is it correct to say that the carrying amount in a statement of financial position cannot be greater than the market or net realizable value of the partially used assets as at the end of the reporting period? Explain your reasons for your answers.
Okay, now let's look at the first one. The first one requires you to more or less tell us much about what carrying amount represents. Okay, can you read that out? What does carrying amount represent?
In simple terms, the carrying amount of an asset is the cost of an asset less the accumulated depreciation. That is, all depreciation charged so far. It should be emphasized that the main purpose of charging depreciation is to ensure that profits are fairly reported. Thus, depreciation is concerned with the statement of profit or loss rather than the statement of financial position. In consequence, the carrying amount in the statement of financial position can be quite arbitrary. In particular, it does not necessarily reflect any relation to the market value of an asset and is of little use for planning and decision making. An obvious example of the disparity between carrying amounts and the market value is found in the case of buildings, which may be worth more than 10 times as much as carrying amount.
Okay, the second question is to explain a situation where you believe that disclosing the carrying amount in a financial position may not be a true reflection of the value of an asset, given that the kind amount sometimes might be as higher than the net realizable value or the market value, and sometimes it might be lower. In that regard, what are they trying to say? Can you read it up?
Carrying amounts can, in some circumstances, be higher than market value, net realizable value. IAS 16 property, plant, and equipment states that the value of an asset cannot be greater than its recoverable amount. However, recoverable amount as defined in IAS 16 is the amount recoverable from further use, IAS 16 paragraph 6. This may be higher than the market value. This makes sense if you think of a specialized machine which could not fetch much on the second-hand market, but which will produce goods which can be sold at a profit for many years.
Okay, now let's look at a practical question on disposal of an asset. Okay, I want you to read this up and I'll explain it to us. Okay, can you read the question on disposal of an asset?
Okay, a business purchased 2 rivet making machines on 1st January 20x5 at a cost of $15,000 each. Each had useful life of 5 years and a nil residual value. The straight line method of depreciation is used. Owing to an unforeseen slump in market demand for rivets, the business decides to reduce its output of rivets and switch to making other products instead. On 31st March 20x7, one rivet making machine was sold on credit to a buyer for $8,000. Later in the year, however, it was decided to abandon production of rivets altogether, and the second machine was sold on 1st December 20x7 for $2,500 cash. Prepare the machinery account, provision for depreciation of machinery account, and disposal of machinery account for the accounting year to 31st December 20x7.
Okay, now let me explain it one by one. Now, 2 of the machines, 15,000 each. Which make it 30,000. Okay, now what happened is that the machine is expected to last 5 years, which means each year the depreciation, annual depreciation, is 15,000 minus the scrap value, which is nil, 0, over 5 years. That gives us average of $3,000 per year. Now, between 1st of January 2015 and 31st of December 2016, 2 years has been used, which means 2 years used means machine A has consumed 2 times 3,000. Machine A has consumed 2 times 3,000, which is 6,000. Likewise, machine B has also consumed 2 years of 3,000 per year of 6,000. Now, machine A was still continuously used up to March, which means for the 3rd year for machine A, 3rd year, he has only consumed 3 out of 12 of 3,000 because it was disposed of 3 months into the year, which means 750 is the additional depreciation, which means in 2 years, 3 months, it is 6,000 plus 750, which gives 6,750 on machine A. Whereas machine B was still in use from January 2017 up to 31st of January 2017, which means up to 30th of November, which means that is 11 months out of 12 times 3,000. And that should be 2,750, if I'm right. And that 2,750 plus 6,000 will have given how much? 8,750 as the total depreciation charge or as the accumulated depreciation. Now, the machinery account, we are supposed to show it as at this date. The balance, which is the cost, was 30,000, if you remember 15 and 15. And all through the year up to these dates, the asset was at the cost of 3,000. But in 2017, the first one was disposed of at 1st of March. What you have to do is to recognize the entire cost and take it to disposal accounts. And on 1st of December again, we dispose the second one. We also recognize this and take it to disposal accounts. Now, when you come to disposal accounts, you find out that they will be debited to that account as a cost. Now, but there's depreciation associated with this cost, which has been aggregated in this 12,000. This 12,000, if you remember, is the depreciation for A and B for the first 2 years, which is 6,000, 6,000. That is what make up this 12,000. Is the sum of these two. Now, in the current period, you've had only 750, which is 3 months for A, and 2,750, which is 11 months for B. That is what make up this 3,500, which is this and this. Now, aggregately, the total depreciation that has been charged on the two assets that were disposed is 15,550. And this amount will equally be derecognized in each period. As at 31st of March, 6,750, which relates to this, will be derecognized to the disposal accounts in order to ensure that this 6,750 is the, once you charge it against this 15,000, that is your net book value at disposal. Which means net book value at disposal for A is 15,000 minus 6,750. While net book value for B is 15,000 minus the 8,750. If you come back here, where do you have the 8,750? The 8,750 is what we have here. Now, we then signify that this is 8,750. If you use our calculator, what do we have? For my own calculator, 15,000 minus 6,750 will give me 8,250. And here, 15,000 minus 8,750 will give me 6,250. Which then means that at the end of the day, how much was, given that these are the value of the assets at the point of disposal, how much was the asset sold for? The first asset was sold for on credit of 8,000, which means you sold it on credit of 8,000. 8,000 falls short the value we have here, which means that one was sold at a loss of 250. While the second one was sold for on cash for 2,500. That means that one was sold also at a loss of the difference between 6,250 and 2,500. That is 3,750. Now, therefore, you recognize as income the proceed of 8,000 and the proceed of 2,500, even though one is on credit, one is on cash. At the end of the day, you find out that your total loss on disposal is for machine A is the difference between the 8,000 and the kind amount of 8,250, which is 250 loss, and machine B, which is 2,500 minus the kind amount of 6,250, which is 3,750. Everything sum up to a total loss of 4,000, which is what was recognized as loss on disposal of 4,000, which will be reported in your profit or loss for the year. Does it make sense now?
Yes, sir.
Okay. Any question on that? Now that's how you treat disposal on assets. Okay, these are things you are very familiar with over time. Okay, now the last phase of our discussion is the disclosure requirements. Okay, and I want somebody to read out our disclosure requirements in line with the requirement of IAS 16. Over to you. Who will volunteer to read?
Okay, I'll read it. Okay, disclosure. Information about each class of property, plant, and equipment. For each class of property, plant, and equipment disclosed: 1. Basis for measuring carrying amounts. 2. Depreciation methods used. 3. Useful life or depreciation rates. 4. Gross carrying amount and accumulated depreciation and impairment losses. 5. Reconciliation of the carrying amount at the beginning and the end of the period, showing the following: 1. Additions. 2. Disposals. 3. Acquisition through business combination. 4. Revaluation increases or decreases. 5. Impairment losses. 6. Reversals of impairment losses. 7. Depreciation. 8. Net foreign exchange difference on translation. And 9. Other movements.
Okay. In addition to that, what you disclose further as follows.
Additional disclosures. The following disclosures are required according to IAS 16, paragraph 74. 1. Restrictions on title and items pledged as security for liabilities. 2. Expenditures to construct property, plant, and equipment during the period. 3. Contractual commitments to acquire property, plant, and equipment. 4. Compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up that is included in profit or loss. IAS 16 also encourages but does not require a number of additional disclosures. Revalued property, plant, and equipment. If property, plant, and equipment is stated at revalued amounts, certain additional disclosures are required. 1. The effective date of revaluation. 2. Whether an independent valuer was involved. 3. For each revalued class of property, plant. For each revalued class of property, the carrying amounts that would have been recognized are the assets being carried under the cost model. 4. The revaluation surplus, including changes during the period and any restrictions on the distribution of the balance to shareholders. You're muted, sir.
Thank you very much. This brings us to the end of the discussion on accounting for property, plant, and equipment in accordance with the requirement of IAS 16. Okay, if there's any other question, kindly put it on the floor before we wrap it up.
Okay, sorry, the question I want to ask based on disclosure requirements. I want to know, is it possible for an entity who have revaluation as its depreciation policy
depreciation policy or policy for subsequent measurement of an asset.
Of subsequent measurement of an asset. Okay, so to actually go about revaluation without an independent valuer.
It depends on jurisdiction. Like in Nigeria, from the FRC guideline, you cannot do any evaluation without being done by a reputable and a registered valuer with the FRC, Financial Reporting Council. Some jurisdictions are liberal, where you can do it internally if you have the expertise. You understand? But what the standard has done is that depending on your jurisdiction, if you have internal expertise and you're allowed to do it, you can, but you must disclose that. The essence of the disclosure is that if you disclose that external or independent valuer did it, it will be much more considered reliable than internal. And also, even when it is external or independent, the caliber of the valuer, the experience of the valuer also will put more credence on people accepting such a value. Do you get what I'm saying now? Which means it's for you to provide enough information that will assist users of financial reports to make informed judgment on the financial performance and financial position of the entity as at the reporting date.
Thank you.
Okay, any other question? Okay, in the absence of none, thank you very much and God bless you guys. Bye.
Thank you, sir.